Good afternoon, ladies and gentlemen. Welcome to the KITWAVE Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. I'd now like to hand over to Ben Maxted. Good morning.
Good morning, and good morning to everyone. Thank you so much for your interest in KITWAVE. If we just dive straight into the pack and just provide a little bit of an introduction about KITWAVE for those of you who don't know a lot of detail about KITWAVE. We are a delivered wholesale business. We have a well-invested infrastructure across the UK, and we specialise in selling impulse products. So that's frozen, chilled and fresh foods, alcohol and grocery, and branded products to the food service and convenience and retail marketplace. We focus our business on our customer base, which is predominantly independent customers, and really looking to provide them a customer service that is, I guess, second to none in the industry. The group was admitted to trading on AIM in May 21, and we've had a successful journey so far. In terms of the business itself, we run a fleet of 550 delivery vehicles, fulfilling just under 5,000 deliveries per day. All of that fleet is really owned and operated by KITWAVE. We don't rely on any third party, and we provide that customer ability for that lower minimum order levels, that high frequency of delivery. Most of those are next day deliveries, really providing that high quality delivery capability for our customer base. We do that out of our nationwide delivery depot network of 30 depots, with 8 main sites and 22 satellite sites that are operating that last mile delivery, and really offering that nationwide delivery capability, ensuring a high level of stock holding and achieving that over 98% of deliveries in full and on time. In terms of our customer base, we have over 42,000 customers, and we have a good, a mix of customers across a nationwide based wholesalers and also our independent retail customers. Majority of our customers are kind of small independent customers and really are reliant on that level of service that KITWAVE offers them. In terms of our board, we have obviously 3 execs and 3 non-execs, with Teresa joining the board in the last financial year, offering expertise from her career with Kantar and Diageo.
And just to clarify there, for those unaware, Paul Young, our current Chief Executive Officer, is stepping down at the AGM to be held on the 22nd of March this year. And Ben, who has been a Chief Operating Officer and a fundamental part of the business for the last 12 years and the strategy and the growth, will step up as Chief Executive Officer at that time. And the company is really pleased and proud of that internal succession.
Okay, so moving on to, I guess, the results for FY23, and I guess it gives us great pleasure to present another set of strong results for KITWAVE PLC. The financial performance is in line with the upgraded expectations that we put into the market in July. And I guess as significantly as the good financials is the progress KITWAVE has made operationally, driving innovation and efficiencies to set that business up for I guess another level of growth, to continue that trajectory that we've seen in the years since IPO. No doubt our commitment to operational excellence positions us favourably in the marketplace, and it's been a strong year for M&A. The acquisition of West Country in December 22, which has been successfully integrated into the food service division, provides us with a scope in the southwest and further product set in terms of fresh produce in food service. The post-period end acquisition of Wilds of Oldham offered a small bolt-on and has been fully integrated into our on-trade business, HB Clark, providing a basic additional depot and geographical spread for HB Clark into Oldham. And finally, we're pleased to announce to the board is recommending a final dividend of 7.45 pence per share, subject to approval at the AGM. And David will now take you through the financial results in more detail.
So it's an overall group performance. Really pleased across the board with all aspects, financial aspects of the business. But I think as we'll lead on to as we go through the presentation, this is down to the key metrics that we employ day to day, but also the day-to-day energy we bring to operational improvement in our business, of looking after our customers and looking to widen our basket size to that customer base. So I'll go into a bit more detail into all of these elements, but revenue up 19.7%, circa 13%, excluding West Country on a like-for-like basis. Importantly, and I'll talk more to this on a divisional basis and against the market, but that's actual 3% case rate growth, with the balance being 10% of circa of food inflation that we've seen in the market. Gross margins, again, key metric for us. Gross margins, for those of you who haven't followed KITWAVE before, are literally the margin we make on the cost of goods. As a delivered solution, we have a deep operating cost to serve behind that, but we assess gross margin literally on the margin made on the goods we are selling before those costs are incurred. And we've improved that significantly, down to mix, but also down to improvements in the actual margins across each division, which has resulted in a 44% uplift in operating profit at £29.4 million. We have a stated aim to keep total leverage well below 2.5 times. That includes IFRS 16 leverage, and ex-IFRS 16 leverage of no more than 1.5 times at a time of M&A. And then, because of our strong cash generation in our group, we will always de-gear very quickly. The IFRS 16 leverage, in majority of that sits with our property leases, and we also have significant numbers of our fleet, which we take on lease rather than purchasing. Ben's just mentioned the full year dividend, which is a 21% uplift on the prior year, subject to that AGM approval. And one of our major metrics is around our cash conversion. And again, pleasing that our net cash from operations at just over £30 million is actually up 3.8 million on the prior year. So looking at all that in a bit more detail, revenues, the vanity stuff, pleasing that we've gone over 600 million for the first time in our group's history, but importantly, it's been in the right areas. So it's in margin enhancing areas where we've moved our gross margin from just over 20% to 22%. We've moved our adjusted operating profit margins up from 4.3% to 5.3%, which has resulted in that adjusted operating profit increase up to £32 million, which again resulted in that mid-year uplift in expectations that we provided to the market. Looking into the more detail there, we split the market into two. So we look at retail and wholesale and food service. But within our businesses, we also, within retail and wholesale, have an ambient-based business and frozen and chilled-based businesses. Reason for splitting that out rather than just presenting at retail and wholesale is because they do command slightly different margin structures, and I think it's important to show it on that basis. So I've already spoken about revenues increasing 12.6%, excluding West Country. And from our point of view, really, really satisfying and pleasing that this isn't one part of our business outperforming the other parts and hiding a problem elsewhere. It's across the board, the improved performance. So ambient, 12% revenue increases, frozen and chilled, 12% revenue increases, and food service, like-for-like sales increasing by 15%. Food service a little bit more affected by those commodity-driven price rises that you may have seen in the markets, particularly around the dairy and the fresh produce. Overall, that makes about less than 10% of our overall volumes. So we will talk about the future later on, but as a result of the fact that 90% of our product base is core branded product that you will know and love, whether it's Unilever, whether it's Mars, whether it's Walker's, whether it's Coke, on the alcohol on trade within food service, whether it's the Heinekens or the Molson Coors, we do not expect, and historically we have not seen price deflation in those markets. So you will see a little bit of price deflation across that 10% of our product base, but not across the core products that we offer to our customers. Food service has moved up to 30% of our overall revenues, and with the full year effect of West Country and post-year acquisition of Wilds of Oldham, we would expect FY24 that to be nearer third. I think importantly, because the margin structures, the adjusted operating profit, again, you can see on the right-hand side here, whilst food service is that 30% of revenue, it's now 45% of adjusted operating profits. And that's down to the different margin structures that you can command within food service and the more loyalty that there is and stickability of a customer base, because it's all about having a single provider that turns up, next morning or twice, 3 times a day in order to get the service levels that chef requires. Just for clarity, food service, a lot more than just the traditional cafe, restaurant, golf club, etc. It's also the local care home, it's the private schools on the local patches, etc. It's anywhere that food is prepared on site as well. So again, part of that business might be in perception that affected more by consumer spend squeeze. Actually, a good portion of that is irrelevant to consumer spend because of the nature of the business that it's in. Pleasingly, those margins, again, have improved across each of the operating parts of our business. Ambient operating margins up from 3.7 to 4.5%, frozen and chilled up from 3.3 to 4.2%, and food service on a like-for-like, excluding West Country, from just above 7 to just below 7.5%. And actually, including West Country, the operating margins in that division now sit at 8.6%, showing the different margin structures that can be commanded. Historically, if I go back 10, 12 years, and certainly pre-COVID, KITWAVE has always had the ability to outdo and grow more than the market has in its own right, and take that bit of market share, as well as maintaining the margin structures it has in the business. And I guess this slide shows against the IGD data, which is, we find, one of the more comparable data sets in the market, that shows UK wholesale values to retail and convenience and food service. Its indicators, we're waiting for the final numbers for the calendar year 23, indicate retail and convenience 4.4% growth. Our year to October 23, we grew 11.8%. Similarly with food service, 8.2%, and our like-for-like growth of 15%. What you will see going forward, coming out of the high inflation, which these numbers include, and as food inflation calms a bit, we expect both of these markets over the next 12, 18 months to return to more their traditional levels of growth, which is sort of that sort of low single digit, about 3% growth. KITWAVE, though, always has the aspiration to more than outdo that, and historically has always achieved that. Away from the P&L, our balance sheet control is as important to us because that allows us to achieve what we want in our business. We have a very high cash conversion rate in our business with an LTM target of 95%. In the year to October 23, that was 90%. That was literally down to a day's working capital, where a customer payment run came in on the 1st of November instead of the 31st of October. Had it been run the day after, it would have achieved the 95%, and that's what we target month in, month out as part of our business. And despite the 100 million growth overall in revenues over the business, actually like-for-like working capital investment only increased by 2.7 million, which shows how we can control that working capital, how we can turn our stock quicker and maintain that high level of cash conversion. Why is that so important for us? Because that allows us to do what we want to do in our business. That allows us to reinvest in our business whilst maintaining a low leverage, whilst continue to pay a dividend, and whilst self-funding our own M&A activity, as we have done since float, with the now 3 acquisitions, including Wilds of Oldham. So during the year, we've had a bit more catch up on fixed asset additions. Coming out of COVID, there was a bit of a delay from brand manufacturers of vehicles getting hold of metal, getting hold of build slots. So we've been playing a bit of catch up on vehicle replacement cycles. By the end of this year, we expect that to be fully complete. About 10 million of that 13.8 million additions in the year was related to vehicles. And there were some other bits that Ben will talk about later on as we continue to invest in voice pick, in our cyber security, and also in terms of our PV on our roofing, which has been the additions on top of that vehicle replacement. Despite the fact that we had a 20 million outlay on West Country in the year, we maintained a very low level of leverage with ex-IFRS 16 at 0.8 times and de-gearing further from that subsequent to the year end. And obviously, we've already spoken about the dividend policy, where we look to maintain that policy, and we're paying out at 41% of profit after tax. I think importantly, at the year end, we still had £40 million of available financing facilities from our banking within our banking finance facilities, leaving us in a very strong balance sheet position to continue our growth story.
Thanks, David. If I just walk through some of the operational highlights, I think in terms of physical infrastructure, obviously post-period end, we acquired the Wilds of Oldham business. That brought with it a depot in Oldham, which we have fully integrated already. It's on our ERP system, and that will run now as the third largest depot of HB Clark, giving us an expansion of geographical spread and also further opportunities to, I guess, route optimize and deliver to that enlarged customer base more efficiently. In terms of Newton Abbot, those of you who follow KITWAVE will be aware that we are investing in an 80,000 square foot distribution centre in the southwest of England, in Newton Abbot. This is about bringing together additional capabilities and capacity in the southwest to really bring together the West Country and MJ Baker acquisitions in the southwest of England. We have 5,000 trading customers in the southwest, and it provides an opportunity to really penetrate the MJ Baker customers with fresh produce from West Country, and vice versa, to continually look to sell more to West Country's customer base, which is predominantly bought produce and fresh produce from the group. The purpose-built 80,000 square foot site will be ready in September. It's currently on track and on budget, and we will look to move the businesses from their existing sites, three separate sites across Newton Abbot, into that new site in October, following the busy summer season. In terms of operational synergies, this gives us the opportunity to sell more to our existing customer base, to deliver within that enlarged southwest customer base a more efficient operating model, and also look to grow our food service footprint with the incremental additions of alcohol and other lines like ice cream from other parts of the KITWAVE group. In terms of our ongoing efficiency drives, we look to invest into our business, as 70% of our overhead is in wages and motor costs. That is a high cost to serve that is required for our delivery infrastructure and our picking warehouses. As we look to invest in this, we're trying to create efficiencies in that model, which obviously looks to uptick our operating margins. Part of that is advancements in technological opportunities in terms of voice pick. So we've committed 150k investment into our Northern Ambient hub to upgrade to a voice pick solution. We continue to roll this out across our depot network and have plans to do 3 more of the pick depots. We have about 12 pick depots of our 30 sites, of which only 5 have what I see as the blueprint for warehousing efficiency, which is a full RF scan goods in, a full warehouse management solution module and voice to pick solution. So we will continue to roll that out. We have invested in 3 new IT heads to expedite the rollout of that over the next 12 months, which will include our David Miller's food service hub and Central Supplies, which is our chilled hub in Birmingham. If we move on to our colleagues, we have really looked to develop and implement further benefit opportunities for our colleagues. KITWAVE One is our employees benefit portal, which has been launched during the year, and this is all about providing a wider benefits package and remuneration to our colleagues in terms of a medical cover, death in service, and retail discount benefits, to really bring additional benefits over and above their pence per hour rates that they are being paid, to really build that morale and look to really bring some ownership as part of them, as part of the KITWAVE group. We've also launched our new License to Lead program, and this is all about really upskilling our employees across all levels of the business in terms of shift leaders, team managers, and warehouse management, right through into transport operating centres and transport operating teams, to give them the skills and empower them to be the leaders of the future of our business. This is a kind of online as well as in-house training function that we have launched, and really look to upskill our warehouse and our driving capability in terms of bringing forward and bringing on the colleagues and giving them the opportunity of upwardly mobile, progressing their career through KITWAVE. If we move on to our commercial and brand supply partnerships, this continues to be as strong as ever. I guess our reason for existence continues to be our strong customer service, delivering to those 42,000 customers. I guess we are only as good as our last delivery, so we continue to strive to be as best as we possibly can, both with our customer service and our operational excellence. Our brand and supplier partnerships go from strength to strength, and they really do continue to see us in that collaborative manner and see us as an extension of their businesses and their route to market partners into that hard to reach independent and food service sectors. You look at our continued development in our online platform, we continue to grow our order capture through electronic ordering platform from 44 to 47%. And this is bringing with it average order value increases of circa 8%. This is really driving some proportion of our organic growth, but also brings with it further collaboration from our branded supply partners. You know, they really are partnering with us in terms of both investment and those partnerships with their own e-commerce teams to drive promotional activity and also brand awareness to our ever-increasing customer base. We continue to grow this, and our expectation is to see this saturate maybe 55, 60% as we look to continue to roll this out into our other companies. West Country, for example, doesn't have a web platform at the moment. And then finally, just from an ESG perspective, we continue to invest in solar. We see this as a real opportunity to I guess, de-risk our energy, some of our energy capability, but also to drive down our carbon usage. So we've invested in a full PV solution at our Luton distribution centre. This now gives us a 10.7% self-sufficient installed energy capacity, and we will look to invest further to try to move that to 20% in the coming years. We've earmarked our David Miller's York site, and clearly the new 80,000 square foot site in Newton Abbot is absolutely prime for PV. In terms of social, Tom Johnson, who many of you may remember has been implemented as our health and safety director, continues to drive through the increased awareness and culture of health and safety alongside a full integrated online health and safety portal, which is really driving the highest levels of health and safety in the business. And from a governance perspective, we continue to drive and continue to look at our enterprise risk management and really embed that in the management of the business on a monthly basis.
So in terms of the ongoing strategy for the group, look, this doesn't change and will continue to be the focus for a number of years. There's really a three-pronged strategy to growth, and the way we look at this is growth in profit terms, not just revenue terms. So there are things we can do in our business to organically grow our revenue streams and earn the extra profit that way. There are things we can do operationally to ensure that whatever we're doing is as efficiently and as cost effective as possible, which also allows us to grow our profitability organically. And then there's M&A as a third strand, which will continue to be a focus of that. And why is all of this possible? I guess just as a brief overview for how our market is built up. As I mentioned before, we really focus on the two aspects of the market, both retail and convenience within our ambient and frozen and chilled divisions, and the food service sector. If I break those down slightly, retail and convenience, you have a big element of cash and carry there, which is Booker and Bestway in the main, and you have some big symbol providers such as Nicer and Blakemore. We actually do a lot of work with Booker and Bestway on temperature-specific products, such as the frozen and chilled offering. So we do sit in that. But if you exclude them from that market, because we're not a cash and carry, we're a delivered solution, we have a different margin structure, there's still a £5 billion market opportunity there, which is very much focused on delivered solution via small regional-based wholesalers. A retail and convenience store will have 3 or 4 routes to market. They'll use a cash and carry for part of it. They'll have a fascia sponsor, such as a Nicer or a Spar, where they'll get a good 50 to 60% of their product from. They'll look at temperature specialists, such as a KITWAVE, for their frozen and chilled product. And if we can bolt on some extra impulse ambient to that, that just enables us to grow that business organically going forward. And Ben will talk to that in a moment. Food service isn't really split cash and carry and delivered. It's the bigger player and small regional player. With the majority of food service, over 83%, being a delivered requirement, which fits right into the KITWAVE sweet spot. The 52% on the left-hand side of that pie chart, Brakes, Bidfest, Booker, they're interested in big national contracts, whether it be a Mitchell and Butler pub chain, big national trust contracts, 26-ton Arctics going up and down the country with minimum drops of £2,000 and above. That's not the market where we play. And that's their infrastructure also isn't able to, and they're not interested in the circa £5.8 billion market that interests KITWAVE, and that's what we're about, which is the 360,000 small independent cafes, restaurants, golf clubs, care homes, private schools that are serviced very, very well on a 40-mile radius from a depot type organisation. That allows us to grow in that market, but that also becomes our M&A pipeline. M&A, 13 acquisitions since 2011. M&A now is very much more focused towards that food service market. You've seen that post IPO with West Country, with MJ Baker, with Wilds of Oldham, all adding and enhancing either a product set in West Country sense, geography into the southwest, or a great opportunistic bolt-on with Wilds of Oldham, where it's much akin to what we already do with our HB Clark business, but we'll get some immediate synergy benefits. And this pipeline is as strong as ever because they're good, well-run regional businesses around the country. It's highly fragmented and it's full of businesses doing 20 to 40 million turnover, 2 to 4 million EBITDA. And that is right in the sweet spot of an M&A target for KITWAVE. And also importantly, not really of interest to the bigger players because it's just too small for them. And below KITWAVE, we're the 14th biggest wholesaler in the UK. You get very quickly down, by the time you reach number 30, to businesses doing 100 million and less. And a 40 million acquisition for them is actually a bit of a sea change. And for a second, third generation family business, people don't want to take that risk on. So 11 of those 13 acquisitions have been off-market deals. We have a good network of people who know KITWAVE as a very safe home for the acquisitions, and therefore we can transact these in a very safe manner. We do our own due diligence on our operations as well as our third-party diligence. So we're going into a business that we know, and we know it will fit in the KITWAVE model.
If we look at our organic growth strategy, clearly we've demonstrated strong organic growth, both top line and an operating margin perspective. And I think both M&A continues to bring synergistic and organic growth opportunities. But we also have those in our own business. We have a large, diverse customer base, and we can look to sell more to our existing customer base. We have strong, long-standing brand relationships, and we are that proven route to market partner in that harder to service independent sector, which brings with it organic growth opportunities working with those brand suppliers. We have a full product offering across all categories in retail and food service, and we have a really well invested infrastructure that allows that nationwide delivery capability. We have a very well invested IT infrastructure, 47% electronic order capture. We are providing the data insights and analytics to our brand partners, and we can drive operational efficiencies into our cost to serve from IT development. And that daily focus on operational efficiencies to drive down cost to serve whilst maintaining customer service excellence will always look to uptick those operating margins within those divisions. In summary, we have a proven track record of organic growth and consistently outperforming the marketplace. We have a strong, dynamic, motivated management team, highly skilled in identifying, transacting, integrating, and synergizing M&A opportunities. We are a long-established brand partner, and we have a significant market opportunity to scale, being the 14th biggest wholesaler. The high cash generation within a prudent approach to gearing allows us to transact that M&A opportunity as well as investing in our organic growth. And I think it's a business which is well invested and now ready for the next stage of growth as we continue our journey as a listed business. And that brings to close the presentation.
Just pass back to you, Mark.
That's great, David, Ben. Thank you very much indeed for updating investors. And I will, if I may, just return your cameras for the Q&A. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the guys take a few moments to review your questions submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. David, Ben, if I may hand back to you. As you can see, you've had a number of questions from investors this morning, so thank you to everybody for your engagement. If I may just ask you just to read out the questions and give a response where it's appropriate to do so, and then I'll pick up from you at the end.
No problems. Thanks, Mark.
Thank you. So yeah, we'll try and run through as many of these answers as we can. So pre-submitted question, Ben, I'll pass this one to you. Are you expecting selling price deflation in the current financial year?
We aren't, and the reason behind that is I think the majority of what we sell is branded impulse products. These tend not to deflate. They haven't historically deflated. So cans of Coke, Mars bars, Magnum ice creams, they don't deflate. I think what you do see is brand partners reinvesting some of their increased margin into share. And really that helps a primary wholesaler like KITWAVE, because what we get is fully funded promotional calendar, promotional activity. And really what that is about is driving consumption and driving share. So Coca-Cola will look to drive share against Britvic, against Pepsi, that kind of thing. And really what we gain from that is fully funded promotional mechanics, which allows us to move organically more boxes. As David alluded to in the presentation, 10% of our kind of goods are commodity linked, and we have seen some deflation in those products. So in dairy specifically, which inflated quite highly last year, we are seeing a little bit of deflation in that, but it is a small proportion of our SKU count and of our revenues.
Okay, I think there's 3 or 4 linked questions here as I'm looking through, particularly around M&A strategy, where we are with pipeline. Do we see a bit more consolidation of bedding in West Country? I guess that West Country was a year past December, but that is bedded in. We bed in the companies very efficiently and very well. We've indicated that with 40 million of headroom at the year end on our balance sheet structure, we have the capacity to look at M&A, and M&A is as strong a point as ever for us. It's about the right M&A at the right time now, and sometimes you progress something and it doesn't go ahead, either vendor expectation on valuation or it just doesn't quite fit. So it's got to fit from both sides. So we're not putting a timeline on M&A, but the business, the infrastructure, the financial position, the management structure is ready to do M&A when it's available. Okay, I'll fit in. Actually, I'll just add one more there, because there was a comment on one question around dividends, linking that to M&A and where we expect the range to be. I guess it's just our stated dividend range, which is in years of lower M&A and CapEx, we expect to be in the mid-higher end of the 40 to 50%. When we do M&A in the financial year, it'll be at the lower end, which is what we've just achieved. So that sort of links in with the answer on M&A. So Ben, I'll pass this one to you. We discussed the electronic order capture going up to 47% at the end of October 23. What's our optimal figure for the business, and do we expect that to be at that level by the end of October 24?
Yeah, I think you should be conscious here. This is about driving efficiencies in the business, about growing organically. This is not about us trying to flip to being an e-coms business. Clearly we are not that. We are very much a customer-facing business. I think the optimum level for us is probably going to hit somewhere between 55 and 60%. There is a generational piece there in terms of a lot of some of the older generation retail and convenience store owners are still not quite comfortable with just online ordering. They want to speak to people on telesales and have rep visits. And I think the key thing for us is really making sure that our 180 or so sales representation and telesales are actually adding value still, in terms of being that brand support, being that brand partner, talking to retailers and food service outlets about brand evolution, about brand new product launches, about planogramming, about merchandising, so that they are still adding value rather than taking orders, which I guess through an online portal can be a lot more efficiently done. And that's really the main stated aim of why we've brought this best-in-class web solution to the market.
I'll just tick off a couple of smaller ones, and then there's 3 or 4 key operational ones I think it's worth picking up. So is there an H2 seasonal uplift every year? Yes, there is. Our business isn't reliant on the sun. It is reliant on footfall, and inherently there is more footfall around the country from that March, April time coming up to Easter to the end of the year, driven by obviously people on vacation, but also just the daylight hours and everything else. It doesn't have to be hot and sunny. But whether it's food service, whether it's you just walking down the street, whether it's going to the park on a Saturday, if you're out and about, you're more likely to pick up a soft drink or a packet of crisps. Or actually you say we're out and about and we'll go in and get a sandwich lunch somewhere in a cafe. It generates a lot more footfall, generates a bigger amount of revenue, and therefore we are a bit more H2 skewed. there was one other I was just going to pick up. It's around, where am I? Yeah, sorry, there it is. The company is new. Please advise that distribution centres and delivery vehicles are primary owned or leased. In terms of the premises, they're virtually all leased. We have about 4 freeholds on our balance sheet, which we've acquired via M&A, and that 2 of those will actually get disposed of once we move into this new premises in the southwest. In terms of our vehicles, it's about 50-50, actually. It's about 250 lease vehicles and about 300 owned vehicles. So it's a nice blend there, and we like that flexibility on that. I guess from the accountant's perspective, it's slightly irrelevant. With IFRS 16, they will go on the balance sheet as acquired vehicles, but we have that good blend within the business. And linked to that, what's the sustainable level of CapEx for the group? Look, the vehicle lease replacements and acquired vehicles on a normal basis is about £5 million a year, and that's ongoing, depending on the timing of the flow of vehicles. Maintenance CapEx for us is really vehicle replacement. Once we have an invested operation from a warehouse and a racking, IT investment continues at a pace, but that's, you're sort of talking a couple £100,000 a year on that basis. So a few more operations which link to distribution centres. I'll combine 2 here, Ben. Are we looking to add further distribution centres? Have we recently done the southwest? And do we intend to? I'll link this one. Where is it? There was a question about going overseas. I can't quite see it, but there was one. Do we think our operations will take us overseas at any point?
Well, no, it won't. I think that we are very much centred and concentrated on the UK marketplace. I think the UK marketplace presents itself with the opportunity, more than enough opportunities than we need to. And I think as KITWAVE's, I guess, ethos is we're very much a business that sticks to our knitting. You know, we understand what we do, we understand our marketplace, and we have the right relationships with our brands, supply partners in the UK. So I think that'll be very much the strategy. Will be to stay in the UK. And in terms of new distribution centres, I think obviously in the past 3 years we've invested in the Wakefield distribution hub for our on-trade business, and that cannibalised 2 to 3 smaller, less invested distribution centres. So that work was done last year. The year before that, 21, we did the same in our frozen infrastructure in Luton, and clearly we've put a big investment into Newton Abbot. So I think for the time being, it is more going to be any distribution centres will be added through M&A, and then we can continue to look at our 30 depot infrastructure and how we can best make that as efficient as possible.
Just linking to growth then in the future, Ben, we obviously mentioned that 13% growth, and we recognise that about 10% of that was due to food price inflation with case rates around 3%. What are the plans to deliver ongoing organic growth? And if I link that to a second question here, which is, can we give an overview of the size of the sales team, and will we grow that to help further organic growth as well? Yeah,
our sales team is about 180 heads, split between probably about 80 telesellers and probably about 100, 110 of field sales reps. And I think we have a very well invested, obviously, a sales representation. We are, I guess, giving them more time in store to grow, I guess, organically our business by taking the order capture away from them. And I think that is really the key strategy here in terms of, look, we want to sell more to our existing customer base. If we sell more to our existing customer base by getting a slightly higher percentage of that basket, clearly that will always drive a higher level of operating margin, because we are going anyway. We have a sunk cost of delivery, and therefore more contribution per drop leads more profit flowing to operating margin. So the focus will be to sell more to our existing customer base, continuing to sell ambient goods and trying that, to drive that strategy of selling more ambient goods to our chilled and frozen supply customers, of which we have a very well invested and well kind of historic goodwill trading relationship with a lot of those customers. So that will be the organic growth strategy in terms of looking to sell more to our existing customer base. And we do not foresee a requirement for a lot more reps or kind of sales representatives to be able to enact that.
Right. Guess one for me, how will the increase in living wage impact in the business, if at all? My opinion is that good people are the greatest asset of any business. We completely agree. We're nothing without the dedication of our over 1,500 colleagues across all parts of our business. Over 70% of our colleagues are warehouse and drivers. And we look to, as Ben's articulated, with the implementation of the KITWAVE One portal, etc., the development schemes from warehouse level upwards, that we're trying to bring people through with a license to lead. It's vitally important that we make careers for them as well, and it's not just about the job and the payroll. But in terms of the specific around the payroll, look, wage costs make up over half of our overhead base, £56 million in the FY23 year. Minimum wage, whilst we're not in and around minimum wage directly, a lot of our payroll is indexed on where minimum wage is, and that covers about 30% of our colleagues. So yes, there's an inflation base. We provided a 6% pay rise to all our salaried employees on the 1st of November last year. And at that point, we brought forward where we thought minimum wage would rise to this April, and gave everyone in and around that index an increment above 6% to get them where we believe minimum wage was going to be. We weren't far off with our estimate on that. And wage inflation will be a continued part of our business, which is why that gross margin control is fundamental to us, because by growing our business, that additional cash gross profit will always cover the inflationary pressures in our overhead base. Right. Could you explain how voice pick solution works?
Yeah, so voice pick, just to give you an idea, voice pick is really about, I guess, guiding our warehouse employees around the warehouse using a headset. So each picker puts a headset on, and essentially the head unit, the voice unit, talks to them. So it basically says to go to an alphanumeric bay location, A1, for example, and pick 4 boxes. The picker then gets to that location, it picks up the box, and it reads back the last 4 digits of the barcode as a check digit to make sure they've got the right product in their hand. They then put 4 onto their picking trolley or onto their pallet, and they say next. Then that unit then basically guides around the warehouse in a far more efficient manner, because old school is paper pick. It's a clipboard and a pen, and you're basically saying 4 Red Coke, 4 Diet Coke, and you're basically up and down. So it's a far more efficient way of picking. You have both hands available to be able to pick, and clearly it is guiding you around the warehouse in a lot more efficient manner. So it's really about, and this is not new tech, this is relatively old, 10-year-old tech. So it's about driving efficiencies in the warehouse and increasing pick rates and really de-skilling the job in a way that product awareness and getting people up to speed. You know, onboarding new employees can take sometimes between 2 and 3 weeks, because they need that product development, they need that product awareness. Whereas with this solution, it is really about driving that efficiency, because essentially the warehouse is laid out in front of them, and the voice pick solution is guiding them around the warehouse.
I'll take these. I think we've sort of covered, but I'll just cover them off. Whilst we have the cash available, do we see the next year being a period of consolidation, settling in West Country? And over the next 2 years, do we expect the acquisition activity to increase, decrease, or remain the same? But I think, as we've said, it's always about the M&A, the right M&A at the right time. What you won't find is KITWAVE doing 5 acquisitions in a year or something like that, because for us, it's not just the acquisition. It's ensuring we're buying a well-run, well-managed business, but with an opportunity to grow it using the KITWAVE size and scale. It would be remiss of us to spend that money to then not allow it to bed in and to take advantage of those synergistic opportunities. And you can't do that if you're doing M&A for M&A's sake and just bolting another one on. And 1 plus 1 will always just become 2, because you never spend the time with it to make it equal 2 1/4, 2 1/2, whatever that might be. So we're not committing to doing M&A at any point in time. But what I will say is the normal traction we've had of 3 acquisitions effective in the 2 years post-float is a very sensible approach for us to allow those to be bedded in. So markets, we're not competing with the very large players. I guess retail and wholesale, because the large players are cash and carry. We're not. Food service, they're big contracts. We're not. Who are our direct competitors?
Yes, I think if you look at the marketplace in food service, our competition is those local one-site, extremely good food service wholesalers that operate within a geographical area, usually about 40 to 50 mile radius from their depots. Those are our competition, but they are also our M&A targets, because it is those companies and those wholesalers that form part of that pipeline for acquisitions that we will look to build a kind of and scale a nationwide food service business off the back of. I think in retail and convenience, it's very much the same. There are local delivered solutions. There are also, smaller white van men who are offering some price-driven products. And then clearly you do have some of the smaller symbol players who we do kind of come up against.
Might be worth just bolting on this one here, Ben, just linking to that. Would our product range be seen as better quality than Premier or other suppliers? I'm presuming Premier stores maybe, but we don't do own brand, but we're branded products, aren't we?
Yeah, I think we are both branded, and I think if you look at it, Premier stores, obviously are owned by Booker, who are owned by Tesco. Yeah, look, we actually service a lot of Premier stores for frozen and chilled off the back of our drop shipment arrangement that we have with Premier. So in terms of branded supply, which is really where we focus, we are, I guess, a kind of route to market partner for Premier. So I guess that gives you an idea of where we sit. We have an element of own label. We have a very small element of own label. It's kind of 7 to 8 million of turnover. And that is not really our reason for being. We believe strongly that it is, we are a brand partner, and we will work with the brands to deliver into that independent retail and convenience and food service sector on their behalf.
So as part of the website development, you mentioned the links with the brands and their ability to get data from us about how customers are using the website, etc. Do we charge the brand partners for that data on our customers or how they're operating? Yeah, no,
this is all about our joint business plan. So we work closely with our brands, and we have joint business plans in place. The investment that we are getting from our branded partners is inclusive of data, and that has stepped up in the last couple of years in terms of their requirement for data, and I guess how we can powerfully use that data to grow that brand's penetration in our customer base, but also work in that kind of tri-party relationship whereby we are providing insights, which essentially enables us to grow the market and obviously grow consumption, which obviously helps the retailer as well as the brand. And clearly we are wanting to grow the market to move more boxes organically.
I think one last one, I think just about covers everything that we've got. I know a few people will be interested, obviously, with Paul stepping down, you stepping up. Paul is a shareholder. Lockups on Paul's stake and involvement in the business going forward?
Yeah, look, obviously Paul's retiring at the AGM, and he doesn't have any formal lockup on his shares. Look, I guess all I can do is point you to his RNS, and the RNS that was released at the point in time when we announced Paul's retirement, that he stated he looks forward to be a long and happy shareholder. Look, he's worked in this business for a long time. He backs the management team, and he knows that the opportunity is there for KITWAVE to continue to grow and produce the dividend yield and the dividend payments that I'm sure will be very helpful. So look, there is no formal lockup, but I can only point you to the RNS.
That's great. David, Ben, you've addressed all the questions from investors. So thank you once again to everybody for their engagement this afternoon. Ben, David, I know that investor feedback will be particularly important to you both, and I'll shortly redirect to the investors on the call to give you their thoughts and expectations. But Ben, perhaps before doing so, if I may just ask you for a couple of closing comments.
Yeah, I think just to reiterate, we feel that we are a business that's set up for the next layer of growth. We are confident in the year ahead, and I guess thank you for your interest in KITWAVE and your ongoing support if you are shareholders.
That's great. Thanks you very much again for your presentation and for your update. Ladies and gentlemen, please do not close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This may take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of KITWAVE Group PLC, we'd like to thank you for attending today's presentation, and good morning to you all.